For years, the stock market mantra has been known as TINA. There is no alternative. Bonds and cash were pretty much at zero, but not anymore. This year has given way instead to the so-called T-bill and chill approach, and even gold is regaining its luster. Dom, are you listening? Costco. Have you seen this? Selling gold bars.
1,900. They're selling out quick, too.
Within a couple of hours, and they don't have a lot of them. The more people look at the global government debt situation, the more nervous they seem to be getting. Are these alternatives behind the September swoon in stocks? Let's ask Rachael Aiken, Senior Investment Officer at Cape Cod 5 Wealth Management, Peter Bookvar, Chief Investment Officer at Bleakley Financial Group and a CNBC contributor, and our very own Bob Pisani. Welcome to all of you. Peter, I'll start with you because I think you really summarize it best when you say this is just the sovereign debt bubble popping. And do you think that will keep people seeking alternatives for some time?
I do. And the bubble peaked when we had $18 trillion of negative yielding securities in Europe and Japan. So this unwind is a global phenomenon. And yes, I think a lot of people are trying to find other things to sort of hide out in. What's most interesting about gold is how well it has traded in the face of the very sharp rise in interest rates in a very short period of time.
I guess the question to ask, just as a quick follow-up, Peter, to that is, at some point, do people say, okay, well, I have my exposure now to bonds, I have my exposure to cash, and I only want a little bit of exposure to gold, and there still is really no other alternative?
Well, the interesting thing about gold is that the demand is not just from investors. We've seen a voracious appetite on the part of central banks in wanting to own gold as part of their reserves. When the U.S. and the EU decided to sort of confiscate or at least freeze half of Russia's central bank reserves when they invaded Ukraine, that was a wake-up call to a lot of other central banks to say, hey, maybe we're safer just owning gold in our own vaults. So I think that central bank bid has been enormous, and I think that is one thing that is also helping to keep gold. Now, that's not necessarily their investment decision, but it's their desire to own things other than U.S. dollars.
Rachael, it's Dom here. I wonder if you take a look at the way things are setting up. We've gone through such a long period of time with those TINA trades. There is no alternative, 0% interest rates, that as soon as you start seeing some interest rates that are on a 4 handle or maybe even a 5 handle, that has to seem attractive to some folks, even if they feel anxious about the sovereign debt market. But can the equity markets also participate to the upside in a rising rate environment?
So, Don, thank you. I agree that, seeing a 4 handle on any tenor is really an attractive opportunity, we feel, for clients, especially. It wasn't that long ago, less than 18 months or so, that we were seeing less than 1%. With that backdrop, there's definitely competition for dollars from the equity market, especially for investors who are reassessing their risk tolerance and who now have that 5-6% return as the hurdle for entering a risk-on market. So in the short term, pressures definitely abound, not only from interest rates, but from oil, from the environment that we're in as far as strikes and inflation. But longer term, the market can and has been able to do quite well in an environment where a 10-year has been, in that 4.5% range. It's just the digestion, or should I say, the indigestion that the market's feeling right now with the 10-year jumping 50 basis points in the month of September.